So I've known many of you for a while, and you guys have been in the fintech space for a very long time. And it's changed a lot, and you guys all work in different areas, like for different types of venture capital firms. So I wanted to dive in a little bit. I think there's a lot of misunderstanding on, what Vanessa can do at Citi Ventures, what type of fund they're running, what Matt does at Bain, what Rishi does at Mayfield. So Vanessa, maybe you kick us off. What types of startups are you guys looking at? Like what stage? And then, which types are the ones that are going to get the most from going with someone like you versus someone like Matt or Rishi?
Thanks, Julie. Great to be here. What we look for at Citi are startups that we can help entrepreneurs scale their companies efficiently and effectively. I think what's important is there's such a wide range of places that you can take funding from right now that finding a place that you can work with and you can grow your company. So at Citi, we look for companies that have a product in market. They may not have revenue yet, but they've kind of set their course. And that's important because going with a corporate like Citi that's got such a diverse business base, a global business base, we want to make sure that we can help that company accelerate the course that it's on. We spend a lot of time at Citi helping companies learn how to navigate large organizations because we often say, especially in this funding phase, the most precious thing that an entrepreneur has is time. And the thing that a large organization can do is chew up a lot of time. And so we look for companies that we think we can find use cases, we can help them navigate Citi and help them grow.
Got it. Rishi?
So Mayfield is an early stage venture capital firm. We're going to be celebrating our 50th anniversary next year, 5-0. And what's interesting about Mayfield, and I think a lot of early stage venture capital firms, is our work is definitely much more an art than a science. About half of the deals that we do, the checks that we write, are the first money into the companies at all. So we're often starting from just founders that we believe have something special. We try to take as informed a perspective on the market as we can. That's where the science comes in, where we analyze big markets and opportunities that we think can ultimately become the next Square, the next Stripe on the fintech side. But truth be told, we're looking for inspiration. And our sort of value add in the ecosystem as early stage partners is company building. We sort of, our motto is people first. We partner really closely with an entrepreneur, and we believe in the intimacy of that relationship on the board, and therefore being a long-term partner. So we always say that once we invest in a company, it's our job to help them raise the next several rounds and really see it as far as it's going to go in its life cycle. So that's kind of what our business is. It takes a long time to do it. But it's a business that we enjoy.
Got it. Matt?
Well, we have the luxury of being really stage agnostic. So we can meet a company at any stage and invest. And that requires us or enables us both to be extremely sector focused. So I do nothing but fintech. That's what I've done for 15 years and counting. And Bain, with our heritage from Bain & Company, we tend to develop theories about markets and segments, and then we go out and try to find entrepreneurs that we can work with in those segments. So we'll think hard about merchant payments and develop a theory about what we think is happening, and then we can go back entrepreneurs who are 2 men or women in a garage or 400 people leading a scale business. So it's this sector focused, stage agnostic, develop theories about markets is how we do it.
Got it. And something else that I've noticed since I started covering this is that there's continuously been more money flowing into fintech, not even just more money, but a greater percentage of the money, since it seems like everything's getting more money these days. Why do you guys think that is? Is it just a broadening of what's considered fintech? Is it more excitement over the opportunities that are out there?
I think it's all of the above, right? So one funny anecdote I'd like to say is that Airbnb is actually a massive fintech company. They have a separate payments arm because they're doing cross-border transactions all the time for millions of customers. So the definition of fintech is really expanding, I think, because we're talking about something as fundamental as money and currency. But also people are looking at the big market opportunities and that are existing across the fintech landscape and how archaic a lot of the platforms are today that are serving customers. And so that makes it really exciting if you have ambition as a fintech entrepreneur.
Yeah, I think if you go back to 20 years ago, there were 2 types of VCs. You had IT and healthcare. That was you had 2 flavors of ice cream.
We did fintech back 20 years ago.
Yes. And what happened was that a set of people then started to think about verticals. Financial services being, 20% of GDP was an obvious vertical to say, hey, maybe tech is going to overlap its historical boundaries of stuff that gets sold to CTOs and CIOs and start invading other industries. But you see it in travel and transportation, and you see it now in every vertical. But financial services is just big, complex, multifaceted. And so it's logical to me that as the venture industry invades every vertical, that financial services would be one where it rests for a long time and goes through its thing of disrupting every facet.
I mean, I think part of what we've seen, there's three things that have evolved over the past maybe 5 or 10 years. First, I think venture capitalists have gotten comfortable with the fact that even though financial services is highly regulated, there's still plenty of room for really fundamental innovation in the space. Second, we've come out of the very early stage where it was fintechs against all the incumbents. And there's such a wide variety now of startups working with incumbents, startups going on their own, incumbents working together. And I think that heterogeneity has really pushed the investment forward. And then third, and this would echo what both Rishi and Matt have said, at Citi, we think that this notion of kind of what industry are you in is actually quite outdated. That we're all going to look back sooner than you think, I guess, to realize that it's now all about ecosystems, and almost every ecosystem is going to have some amount of fin in it and some amount of tech in it. And therefore, depending on how you think about that definition, you start to see a lot more investment across the board.
Got it. And since it's fintech, financial companies are valued a lot differently than a tech company is. So when you guys are looking at different types of companies to give capital to, what types of metrics are you looking at? And is it usually valued more like a tech company, finance company, something in between?
I mean, so I think this is a really good question because we can see examples where that dichotomy, that question of is it a fintech, financial services company or a technology company plays a meaningful role in valuation. The example that hits close to home for me is Square, where we went public at a $3 billion valuation, which was a down round from our last private company valuation before we went public in 2015. And it was largely because Square was viewed as a payments company. It was covered by payments analysts. And as the industry started to realize that Square was in fact a technology company that had real differentiation in the nature of its tech-enabled customer relationship, the bigger story of Square started to resonate with the financial community, and now it's a $30 billion public company, right? So I think the other place where this is an important question is InsurTech. InsurTechs are valued at 1 times book value or 0.9 times written premium, sort of in that range. And for a company to, and this is what we think of, even at the Series A stage, is a company using technology to create a unique relationship that gives them long-term leverage and can continue to be tech-enabled over time. If we think that's the case, you have a good chance of making the case to investors in the long run that you are actually a technology company.
I think, we try to look at it on a first principles basis because you could convince yourself at various points in time that the market is, for instance, 3 years ago valuing lending companies like tech companies.
Right.
But, looking at the comps can be extremely misleading because it tends to be temporary. Our view is that software is effectively the best business in the world. Recurring revenue software, $1 of that is worth the most. Payments is worse than that. Payments, you have regulatory risk, you have data breach risk, so it's a degraded version of software. The more software you have in your payments, the better. Hence, Square trades at a premium to Global Payments, trades at a premium to First Data. And lending is worse yet. Lending, you have regulatory risk, credit risk, liquidity risk. And insurance is kind of between lending and payments. So you should look at $1 just meaningfully differently depending on the risks and durability and gross margin profile. And then the market's going to freak out and does what it's going to do. But things will settle based on the quality of the dollar of revenue.
I think also, certainly at Citi, when we think about fintech, we think pretty broadly, not just about sort of front office fintech, consumer payments, that sort of thing, but also, what are all the other technologies that are required to enable financial services? So how do you think about cyber? How do you think about machine learning? And to the point earlier, there are lots of different ways that one can imagine how the markets will value those companies. What we look for is really sound principles in terms of business model. And I think, whether it's Square or other fintech companies, those have sometimes been misunderstood at the beginning. And so we try and work with our entrepreneurs to see what's their vision, not for the valuation, but what's their vision for the business model, for the use of data, and how does that come together in something that we think will be scalable, not just to wherever they've started in fintech, but where they think they want to go over time.
Right. And Vanessa, I want you to take this question first because you come from the corporate background too. What is your view on, the competition with large banks like yourself, and then what companies is it best for them to partner with someone like you guys or just get acquired by someone like you guys?
So I think it's important to note, first off, that at Citi, we don't acquire our portfolio companies. It's critical when you're thinking about starting a company. Most entrepreneurs, the first thought in their mind isn't, gee, who do I want to sell this to? It's how do I want to change the world, and how do I make sure I can grow this to be that company that propels a change in the world? But what we think is that in many cases, innovation, it's sort of like a biological system, right? It requires change in all sorts of different places, and you can think about that as a bit sort of the frontier of how that system grows. And I think what we're seeing now that's quite exciting is not just a startup over here or an incumbent over here, but everyone kind of pushing that frontier forward together. To the answer of which kinds of companies should work with an incumbent or not, I think what you've really got to look for is there an incumbent that it makes for an interesting partnership, right? How do you think about, either distribution partnership or even just the know-how that comes from many decades of working in a particular market? We've seen this both on the consumer side of our business and also, I think, on the institutional side of our business, which doesn't necessarily get as much airtime, but with companies like C2FO and High Radius, whether it's dynamic discounting or receivables, if you went and did a search on how many people talk about payments versus receivables, everyone talks about payments. Receivables is actually a very hard problem. And so you find hard problems like that where I think partnership can be really prudent for both parties.
Got it. Your guys' thoughts?
Yeah, I mean, just one thing to add to that, Vanessa, is that there's something really interesting about fintech entrepreneurs, which is that you usually have to not just be great at creating an incredible product. You exist in an ecosystem with very large, well-funded competitors with huge balance sheets like Citi, where part of your job as an entrepreneur is to interact, usually, not always, but usually, is to interact and manage relationships with the other players in the ecosystem, right? Square, just to use that example again, sort of exists at the pleasure of the card networks, right? So in this particular market, I think fintech writ large, your founders generally are not sort of two folks in a garage coding or hacking. There's an element of sort of business development that's really important, the B2B element that's important, even if you're building a consumer product.
Right.
Yeah, I mean, I think when you think about who's going to win, what determines that, it differs based on various lines of business. But simplistically, you could say, distribution, product, regulatory status, and cost of capital, simplistically. And it's very different whether you're talking about, accounts receivable technology versus small business payments versus the DDA space as to which of those matters most. And banks tend to have incredible regulatory footprints, always have the lowest cost of capital, have mixed results in terms of distribution. Sometimes they have the customers, and other places like small business, they don't have the customers, and they rarely have the best product. So if you're in a space where product, like Square is a great example, product matters a ton and distribution matters a ton. Square beat the banks. There's not, Chase at Payment Tech lost the micro merchant battle to Square, and they're a wholesale provider to Square instead of a competitor. So that's an example where the fintech company should go it alone, and they did. Unsecured personal lending, banks have huge advantages in that space. And for Lending Club to think that they could stand up a business and beat the banks in an area where funding cost matters the most, that didn't make a lot of sense to me. So I think you got to really think about what's the basis of competition in your business and how do you stack up against the incumbents on that basis, and then make your decision about whether you partner or compete.
Got it. So OnDeck is someone that you invested in and did decide to do partnerships with banks. Do you remember sort of the thought process behind that? Was it thinking that that was just simply the better route because of that advantage?
Yeah, well, So on deck, if you think about it, funding cost disadvantage relative to banks, obviously regulatory disadvantage relative to banks. We think product matters in small business. So in consumer lending, it's a FICO score. Everyone knows what a FICO score is. In small business lending, FICO score is irrelevant. FICO score of the business owner, turns out, doesn't matter. What you need to know is the health of the business. So we felt it on deck, and I think we've proven that we could build a product advantage over the banks. Distribution is a jump ball. The banks have a lot of small business customers. They don't find them particularly profitable. They don't usually, seek them out, but they end up with them. And so at On Deck, we thought we could both find segments where we go direct, and we have, but also there were vast segments of banked small businesses where we had to meet them where they were. And so a dual strategy. And by the way, a dual strategy is really hard, really, really hard. The DNA of a company tends to get set. And if you get set as this insurgent, combatant, we're going to go win the customer, it's also really hard then with half your brain to be like, oh, and by the way, we're going to bear hug these banks and we're also going to help them win. And I credit Noah Breslow and the team there for managing both sides of their brain to succeed on both fronts.
Yeah, and then one other follow-up on there too. You said you guys don't ever acquire any of the companies that you invest in. Would that change? Because I know that Clarity Money, which got acquired by Goldman Sachs earlier this year, was an investment for you guys. Was there ever a consideration that maybe you guys should have acquired them instead? Like, I know it makes a lot of sense for Goldman Sachs using it in their Marcus unit, but is that just like a strict, we're never going to acquire them? Or if the opportunity presented itself, could that change?
So I suppose one can never say never, but we think it's really important to focus on how do we move this whole ecosystem forward? How do we find entrepreneurs who we can help them grow companies? And like I said, I think that it puts you, especially as a corporate investor, it puts you on the opposite side of the table really quickly. We tend to be in companies relatively early, not as early as Rishi, but relatively early. And those companies are not anywhere near yet thinking about what their exit strategy might look like. And I think that's a critical time for setting them on a course of growth. So I wouldn't, maybe never is the wrong word, but our principle is how do we help these companies grow, and whatever exit is the right exit for them is something that we will support. And that's, by the way, a privilege of being a corporate investor, right? We focus so much on strategically what's good for our clients, what's good for our portfolio companies, and how can we bring those two things together. And it enables us to be less maniacally focused on, what is the exit that's going to be most advantageous. We've got all sorts of partners who we co-invest with all the time who are much more focused on what's the exit strategy look like.
Got it. All right, so we have time for about 2 more questions. First one is, which areas of fintech are most exciting to you guys right now? It can be anything from cryptocurrencies to insurtech to lending to payments, across the board.
I mean, we've doubled down over the past several years on machine learning, which I know isn't maybe squarely in fintech, but like I said before, we pay as much attention to the enabling technologies as we do to companies that might brand themselves in fintech. So whether you think about companies that are using machine learning to get clients better deals like Hopper on travel, or companies like Anaconda who are trying to think about what are the tool sets that are going to be needed in order to build better models. Again, we think that is a space, I guess AI has been around since 1965. It's not here yet, but we do think that both the technological advances and the behavioral advances in terms of how people are using these insights make that a really interesting place.
Yeah.
We're taking a really broad view on, I think you're right, that's an important enabling technology. We tend to take a little bit of a consumer lens to fintech, and so the most interesting space for us, I think right now, is a very broad thesis around real estate tech, or they call it prop tech. We don't like that term. We think that the way that everyday people are changing their relationship with their physical space is really important, whether it's everything from how you sort of find and then ultimately buy and finance a home. There's a bunch of interesting companies in that category, and there hasn't been a lot of change in that for a really long time, to what it's like to live in a home and the costs and management associated of being a homeowner or of being a renter. And then what it takes to actually turn this asset into a more productive asset over time, and what are the different uses for a home. that you can have. And so pretty broad thesis, but one that I think comes down to how do people, and especially Americans, interact with their most valuable asset. I'm a personal investor in Opendoor. If you're familiar with that company, it's enables you to sort of sell your home in a day. And we really like sort of these little moments that can be enabled by thinking of something crazy. But that when
Come
you
back around
into
2:30 because the CEO is getting interviewed.
Nice. He's awesome. That's going to be a really, I think, rich area of investment over the next couple of years, and probably for a long time.
Yeah, so I've been thinking lately about this real estate thing because, frankly, to me, fintech is payments, lending, investing, and insurance. Kind of like full stop.
Didn't you get flack earlier this year for including real estate in fintech?
I give myself flack for it. My partners give me flack. Like, it's not fintech. But I think, here's my synthesis of this. Let me see if this works on this crowd. The interesting problems in real estate are fintech problems. They are insurance problems. They are lending problems, the whole mortgage market, title insurance. They are payments problems, rent payment being a big thing, and investing problems, companies like Cadre and Roofstock. And so I think that we have permission to play as fintech investors in real estate because the core problems are ones we understand. And increasingly, if you think about other verticals, Airbnb as a payments company, for instance, travel has massive fintech problems. Right. Healthcare has massive fintech problems. So I just bought myself another couple decades, is my view. Like everything's in baths because there are fintech problems everywhere I look.
Yeah.
To me, I'm really interested in like big markets with vulnerable incumbents. Like that's a great framing. And I think payroll and benefits. There's been good work done by companies like Gusto. We have a company called JustWorks. But there's work being done right now in the pre-tax savings area with really exciting entrepreneurs. I think huge horizontal market, very consolidated in a few players, none of whom are known for product excellence. I like that recipe.
Yeah. But I think that the point that Matt's making is a really important one, which is that it's very hard to find any sector of one's life, be it individual or corporate life, that doesn't have some amount of fin and some amount of tech. So, you guys can broaden how you think about the definition, but I think that's important that we have in our mind that fintech means something narrow because that's where it started. But in actual fact, these challenges that people have about managing money and using technology as a way to enable that, they really spread across almost any sector that you can think about.
Right. All right. Quickly, because we're running out of time. What company? Since you've mentioned Square a number of times and it's done very well since its IPO, what company in the fintech space, whether you've invested or not, is the next Square?
I hope people aren't sleeping on Affirm. I think it's a really exciting company, incredible founding team. I'm not an investor, sadly for me, but I think, I won't mention any companies by name, but if you think about large markets with vulnerable incumbents, I think they're targeting an interesting one. Yeah. Incredible talent. And if they can close the loop in a way that Square started to as well, where they actually have consumer relationships that are durable and ongoing, as well as merchant relationships, Katie bar the door.
Yeah, it's an opportunity to build a two-sided network, which is, incredibly valuable. Discover is the fourth largest credit card company, and they're worth $26 billion. So that
Affirm, for people that aren't aware, is a point-of-sale financing company that is founded by a guy that was one of the co-founders of PayPal, Max Levchin. Yeah,
and it'll be a real testament to, I think, perseverance as that company grows, because they've been at it for a long time. I mentioned Opendoor. I think that's a really exciting company. I think you can't have this conversation without talking about Robinhood. I know we have Vlad here later. It's a company that definitely is in the tornado market in terms of taking a sort of an idea that to some seem preposterous. I really like those kinds of ideas, free trading, and have created something that has a tremendous amount of momentum. And there's a lot of things you can do when you have that customer relationship. Right. And so I think that's going to be a very exciting one to watch as well.
We're particularly interested in companies that behave like ecosystems, right? So companies that think about using data in fundamentally different ways and therefore expanding outside of what looks like an obvious place that they work, whether that's, an Airbnb that is thinking about, finance in addition to, getting you a room for the night, or any company that is taking that data and using their core competencies against multiple places in the ecosystem. And I think we are increasingly going to see companies blur the lines across industry.